Thank you for listening in here for our Signature FD fourth quarter investment review and our look ahead to 2025. I'm Tony Welch, Chief Investment Officer at Signature FD. Now, the economic and investment landscape is complex, but we're going to try to take a little bit of time and focus on some of the most impactful trends of the last year. And then we're going to try to think about how they look going forward here for this year. So here's what's on our agenda for today. The fourth quarter was solid for US large cap stocks, and it capped a second consecutive year of strong gains. Now, other market segments ran into some notable headwinds in the fourth quarter. Now, the US economy's been humming along, driven by really robust consumption trends. Now, we do see some shifting winds for the consumer, so we'll talk about those risks and what they may mean for economic and earnings performance. And finally, we'll discuss our 2024 strategy that was overweight stocks through the year and what we're looking at, which would make us change that posture here as we look and think about 2025. So here is 2024 in a graph for major asset classes. Now that top purple line, that's US large cap stocks, and we proxy that by the S&P 500 index. You can see that large caps returned 2.4% in the fourth quarter and a very strong 25% for the year. Now, there were a few hiccups along the way, but generally, downside was pretty limited throughout the year. Every other asset class, including small cap stocks, international stocks, commodities, bonds, and the US dollar, had positive returns for the year, but the other stock market indices, they struggled in the fourth quarter. And that was really driven by rising interest rates and a stronger dollar post-election. Even so, last year was a good one for investors, but generally the biggest US companies have somewhat been running away from the rest of the market. Now, the consequence of mega cap stock dominance is that the market's never been this concentrated. The bottom clip of this chart shows the weighting of the 10 largest stocks at any given time within that S&P 500 index. Note that 10 stocks now make up nearly 40% of the index. Investors have never been less diversified when they've invested in the S&P 500. Now, that's not necessarily a problem as long as the other stocks are also heading higher, which was largely the case in 2024. However, in the fourth quarter, we did start to see the smaller stocks moving lower, which is something we'll have our eye on early here in 2025. Now, the US economy was a tailwind for investors last year, but economic growth was far from perfect. The US economy is primarily driven by service spending, so that's the most important component to be growing. And in this chart, the dashed red line in the top shows a measure of the service sector, which was an expansion all year long. Now, the blue line, however, that's manufacturing, and we can see that manufacturing was contracting throughout 2024. Now, other economic sectors that saw some pressure were housing and small business. All told, though, the US economy expanded about 3% last year, which is a strong growth rate compared to the roughly 2% that one would expect in a steady state. Now, you might be wondering, where are people getting this income from in order to keep up their high spending levels? Well, a few years back, it was the pandemic stimulus. But those excess savings from the pandemic, those have largely been spent now. Instead, we see three main drivers today. The first is that real incomes, which is what people earn after taking into account inflation, those were up about 3% last year. That's a strong level. Also, the Fed didn't start cutting interest rates until September, and rates still remain pretty high today. So the higher income cohort, they've been making a lot of interest income. And finally, there was a very large wealth effect last year driven by rising house and stock prices. And that's what we're showing in this chart. Through the third quarter data, the year over year change in the housing market was about 7%, and the stock market was 29%. So that adds up to a particularly strong wealth effect. Now, there are some risks to each of those factors in the year ahead. And we're really keyed in on real wage growth. And here we do notice that there's been some softening in the labor market that we need to pay attention to. So this chart here shows a real-time estimate of wage growth in blue. Note that there's been a steady easing in wage growth over the past 2 years. The most recent reading was 4.3%. Now, easing wage growth has been coming down because hiring has also been easing. We can see that in the purple line. The hire rate is near its lowest level since the pandemic. And because of that, people are quitting their jobs less. We see that in the orange line. So if wage growth continues to decelerate, but inflation does not turn lower from here, there's a risk to real income growth in the year ahead. Now, another challenge in this year is interest rates. Longer term rates began rising following the Fed's first rate cut in September, and that move accelerated post election. Interest rates are starting to get to a point where they're rising far enough, fast enough to create some economic and stock market friction. This chart shows an index in blue in the top, which tracks the average US stock. So it's not top heavy like the popular benchmarks. In orange in the lower clip, we're showing the 6 month change in corporate bond yields. Now, they've been on the way up, which has historically been a headwind for the average stock. That's a big reason why the big cash cows that make up the top stocks in the US began to decouple from the smaller stocks in the fourth quarter. Smaller stocks tend to rely more on the capital markets for funding. Now, we'd like to see rates stabilize or even fall from these levels here early this year to have higher conviction that we're in for another good year in 2025. So we think there are some economic risks in this year ahead, but there was pretty strong momentum coming into the year. This chart shows a proxy for the economy in the top clip, and it shows a robust economic timing model that was developed by our friends at Ned Davis Research in orange in the bottom. Now, their model includes 27 different indicators that measure the health of various economic sectors. This model was improving throughout 2024, and it looks like it was finishing the year at a high point. That tells us that there's at least some margin for error on the economy in 2025, where you could even get some easing in economic activity without a recession. So, turning specifically to the investment outlook, the past 2 years were very strong and characterized by very little downside volatility. Last year, we saw 57 new record highs for the S&P 500 index. That's what the orange bars in this chart are plotting. We find that in years where there's more than 30 new all-time highs, the subsequent year tends to only gain 5.8%. Now that sounds fine, but it's actually less than the average. And consider that one characteristic of big up years is few and shallow corrections, and one characteristic of years that return less than average are more frequent and potentially deeper corrections. So that's our expectation for the year ahead, more volatility, but not necessarily a negative year when the dust all settles. Now, another reason to ratchet down our return expectations is that we're now in year 3 of the bull market. The first 2 years have not seen very strong earnings growth yet. So the upshot is that valuations have gotten pretty expensive. In the third year of past bull markets, what we've seen is a trend where earnings grow, supporting continued gains, but valuations actually come down a bit. So that implies that earnings tend to grow more than your investments in the third year of a bull market. So for 2025, what's our expectation for earnings? Well, it's about 8%. So we wouldn't expect the market to return more than that given the high starting valuation this year. Now, when we look at the investment landscape and try to consider where valuations are less demanding, we should at least consider international stocks. Here, we're showing the valuation for international stocks relative to the valuation for US stocks. Now, one can think of valuations as really the ultimate investor sentiment indicator. And by that definition, we might conclude that investors see the US market as the only game in town and have written off international markets as having no possibility for positive surprise. We like to take note when sentiment reaches those types of extremes. Now, one somewhat common refrain that we've heard is that the potential tariff policy makes US stocks more attractive than international stocks. And we're just not sure that folks are looking at that the right way. This chart shows how much revenue for major regions is derived from foreign operations. The US is relatively insulated in comparison, but consider that 41% of revenue comes from foreign countries. So here's the issue. If tariffs end up being universal rather than targeted, it's going to be more difficult for US companies to sidestep the impact of those tariffs on any of that 41% of revenue. And it also makes for potentially more expensive supply chains, even for their domestic business operations. International companies would obviously be negatively impacted on their US operations, but not necessarily their other geographic exposures. Something to consider. Regardless, all else equal, tariffs do tend to drive some economic slippage, so that could be a risk in the year ahead. Thinking about fixed income, the strategy for now is to keep your fixed income relatively safe in what we would deem high quality core bonds. Investors aren't getting paid much of a premium to go out and take more risk and take on the higher default risk right now of more risky bonds. That's what this chart is showing is how much extra yield you're getting versus less risky bonds if you're in high yield corporates, which are the gray line, and investment grade corporates in blue. So, given our expectation of more stock market volatility this year, we want our bonds to be a portfolio hedge for now. If spreads widen out at some point in this year, that could be a good opportunity to grab some more yield and take on more default risk, but that just isn't where we are today. So, our strategy in 2024 was relatively simple, though maybe not always easy to follow. We wanted to be overweight stocks in general, especially those large cap US stocks. There were other reasons, but mainly economic growth was improving and inflation was stable. This table here shows the annual return for stocks and also for bonds in various mixes of economic growth and inflation. We can see that historically, stocks have done quite well when growth is rising and inflation is stable, and bonds have just not been able to keep pace in that type of an environment. Now, for the year ahead, our expectation is something of a downshift in economic growth. Now, whether that just drops us into these stable growth zones or all the way to the weak growth zone, that's going to be important. Stocks have still tended to perform pretty well in stable growth environments, but they tend to show negative returns when growth is weak. Regardless, we'd note that bonds tend to be more competitive with stocks as economic growth downshifts, regardless of the inflation regime. So, our expectation is that at some point this year, it'll be appropriate to take a neutral stance on stocks relative to bonds. Now, within the stock market, we also think it's appropriate to start thinking about true diversification. The so called Magnificent Seven stocks have truly been an incredible story. And here in the top clip in blue, we're showing the trailing earnings growth for those seven companies, which was a very strong 54% through the third quarter last year. And in orange, we're showing that the rest of the S&P companies, they showed no earnings growth at all. This year, analysts expect earnings growth to gradually ease for the Mag 7 stocks and accelerate for the others. Now, we have no way of knowing if that'll actually transpire, but we're confident that the Mag 7 will not grow earnings by 50% in perpetuity. It makes sense to rebalance some of our large cap growth exposure into some less fully valued areas throughout the year. And we're not saying that that's as easy as it sounds as an investor. Rebalancing often entails selling what's worked the best and buying what's not. In doing that, you're probably recognizing some long term capital gains in the process. But here's some eye popping statistics. We took a look at a balanced portfolio of 40% core bonds and 60% stocks, and we spread that stock allocation between large cap value and growth, small caps, and international markets. Now, we started this analysis at the pandemic lows, so this is definitely cherry picking. But note that since that time, if you'd done no rebalancing, you would now own only 23% in bonds instead of the 40 you started with. Your exposure to growth stocks would have gone from just under 18% to almost 29%. The portfolio would have a vastly different risk profile than you set out with. And that might be okay depending on your own individual situation, but leadership doesn't remain the same forever. Rebalancing is all about risk control. After 2 years of very strong performance, it's probably a good idea to book some of those gains and reallocate in the year ahead. So, to recap, last year was a second consecutive strong year led by mega cap US stocks. We expect this year to be more volatile than the prior two, and the degree of that volatility will depend on the economic and earnings trajectory. Fortunately, we appear to be entering 2025 in pretty good shape from an economic perspective. Risks include higher interest rates, inflation, or a dollar that continues to strengthen. And we need to keep our eye on real wages as well. Last year, we were overweight stocks, and that was the right tilt to have. This year is likely to be a year of rebalancing and diversification. As always, thank you for joining us, and we wish you a terrific year ahead.